Hello, good day viewers. Welcome to the SMC cycle. Today I'm going to teach you a very simple smart money trading strategy. Even if you are a complete newbie or a struggling smart money trader, this will definitely help you. Just stick with me to the end. Make sure that you didn't skip any part of the video. My English is actually not that good, so you just got to bear with me. So before I should dive deep, let me just actually briefly give you some hints through theoretical aspects. Let me give you some basic market structure. This is basically how market moves. It actually forms a higher high, higher low, higher low, higher high, higher low, higher high, higher low. Then the market will definitely begin to change character. This change of character happens when the market changes direction from the bullish to bearish or from bearish to bullish. This is basically how market moves actually, which is a basic market structure. This right here, we call it a break of structure. A break, since this structure breaks the previous high. We call it break of structure or BOS. Each and every break, we call it a break of structure to the upside. This is a break of structure to the upside. Let's just mark it as B. Likewise, from the bearish perspective, this is also a break of structure, but a break of structure to the downside. Let's just mark it as B. This is also a break of structure to the downside. Also B. And here, a change of character happens. As you can see, the market changes structure from bullish to bearish. We call it change of character or chalk. Sometimes we just mark it as C. So this is just basically basic market structure. But the market doesn't move like this actually. So let's clean this up. So this is basically how advanced market structure looks like. You might see a market moving like this because the market will never move in a straight path. You might see something like this. This is where things start to get complicated. We're just trying to replicate how actually the market actually really moves. From this type of price action, you are not going to mark this high as your break of structure. Your external swing high should always be your should always be your break of structure. Like this one, your external swing point. Like this one is your swing high. This one is your swing low. This one is your swing high. This one is your swing low. This one is your swing high. Swing low, swing high. You are not going to consider this as your swing highs. No. I'm not going to consider that as a swing high. So this is your break of structure right here. This is your break of structure. Your market breaks structure here, and also it breaks structure here, but not here. This is where some people get confused and actually took some kind of wrong trades. So you cannot mark this. You cannot mark this as your break of structure, but rather this one. This one is your structure break. So I hope you're starting to understand this. So always when you're trying to take your trade, but let's talk about order block. Okay, now let's clean this up and talk about order block. Order block. When we say order block is usually the last bearish or bullish candle before the impulsive move. For example, we have 3 candles right here. For example, when we have 3 candles right here, this is for the bullish scenario, actually. This is for the bullish scenario. Assuming this is your order block, this is your last bearish candle before the impulsive move to the upside. You can mark this as your order block. And your order block has to have a fair value gap for it to be a high probability order block. A fair value gap is just the gap between the first candle, like this one, the wick of this first candle. Usually the formation of each and every candle has wicks. So when you have a space between this first candle and the last candle, we call it a fair value gap. So whenever your order block has a fair value gap, actually it's a high probability. It's a high probability order block. But whenever you saw the wick of your first candle coincides with the wick of your third candle, then definitely your order block is actually a low probability order block. But it might work in some scenarios. So now, same goes for bearish price action. As you can see, same goes for bearish price action. The last bullish candle before impulsive move to the downside is your order block. There are some criteria that you need to understand when trying to identify your high probability order block. Let me list a few before we should move further. But before that, make sure you like and subscribe to this channel. It won't cost you a dime. Just to motivate me to make some other helpful and interesting videos for you. It won't cost you a dime. Just hit the like and subscribe button. Okay, now let's talk about order block. Order block is just the last bearish candle before the impulsive. For example, when this is the price action, we're having higher high, higher lows, higher highs, and something happens like this. So as I told you earlier, this is your breakout structure. So in some scenarios, an order block might form right here, and also right here, and also right here. So now let me introduce you to the concept of Fibonacci level, Fibonacci retracement. So when you see some scenarios like this, where it has multiple order block, as you can see, you can drag your Fibonacci retracement level. So if you did that, all you need to do is to identify your order block that sits below the 0.5 of your Fibonacci retracement. So as you can see right now, we have this first order block, second order block, and third order block. All of them sit below the 50% of the Fibonacci level. As you can see, this first order block that lies below the 0.5 of the Fibonacci level doesn't sweep any liquidity. So it might be a liquidity. So it might actually probably be a liquidity. So the only way for you to identify whether this order block is going to work, because it causes the break of structure, and usually the order block that causes a break of structure, price usually traces from it and goes up. But we are not just going to place an order right there. There's something we call confirmation, fractal confirmation. You should always wait for fractal confirmation from your lower time frame. For example, when you're trading in a 15-minute time frame, like here, whenever your market started retracing to the downside, you should drop down to your lower time frame. For example, your 1 minute or 3 minute time frame to look for confirmation. The confirmation is like this. You might see your market moving in such direction. So all you have to do is look for a change of character from your lower time frame. Whenever the change of character happens like this, then you will look for an order block that might form right here. A small order block from your maybe 5 minute, 3 minute, or 1 minute time frame. Then you should place your order. From there, you should ride the market upward. One of the benefits of using such confirmation is that your trade probability should actually be higher. And also your risk to reward ratio will be much more higher. than if you just use normal entry, normal pacing order. And in some scenarios, your order block might cause a break of structure, still be below 0.5, and will come down. Just destroy this order block and then start to form some kind of structure right here. Then you should take your trade. That's the benefit of looking for that's the benefit of looking for confirmation from your lower time frame. Now let's go to the chart and show you some examples. This is what we are talking about. When you are trying to identify your market structure, always mark your swing highs and swing lows. Mark your swing points. As you can see right here, your market is moving. This is your lower low, lower high. This is your lower low. Not this one, because this one doesn't break any structure. It doesn't break any structure to the downside. Then this is your lower low, lower high, lower low, and this is your high is somewhere around here. Because this one, there's something we call our pullback retracement. This one is actually not your high. This one is actually not your high, because the pullback contains few candles. We want to see multiple candles to consider it as a high. So now this is your high, this is your higher low, and then it continues. Now this is your high, then this is your lower low. It changes character. This is the change of character that we are talking about. It changes character. So this is how the market goes on and on and on and on. This is your higher low. This consists of multiple candles. So it's a higher. It changes character again. So this is what we call internal market structure. The internal market structure are these ones. As you can see, this one is a little bit. It's a higher low, then this higher, then this higher low, lower high, lower low. These are your internal market structure. You are not going to consider such market structure, as you can see, because they doesn't actually break anything significant until it breaks this previous low. It is still considered as internal market structure, which is unimportant actually. Now, as you can see right now, your market changes character right here. Then it forms a lower high, then a higher high right here, which means it is trying to come back to this order block. It is trying to come to this order block before actually, and then maybe continuing its original structure to the upside. So now all you have to do is mark your order block. This is your order block. This last bearish candle before this impulsive move is your order block. Mark it and drag it all the way. As you can see, the price still hasn't reached the order block yet. The order block, it seems to be valid because, as you can see, the order block sweep this liquidity, this little liquidity. The order block sweep this liquidity, and also it has a fair value gap right here. As you can see, here is your fair value gap, and the fair value gap is massive. It actually serves as a magnet. So now, since we know that the price is actually heading to this order block, all we have to do is drop down to a lower time frame, find confluence that will ride this market downward to this order block. Maybe we'll find an opportunity somewhere around here. So we are in a 4-hour time frame right now. And also time frame, all this time frame means if you are a complete new beginner, for 4-hour time frame, it means each and every candle, it took each and every candle a complete 4 hours to form. As you can see, this candle, it took it 4 hours to form. And also this massive candle, still 4 hours. Still same thing when you drop down to your hourly time frame. and also 15-minute time frame. Also, whatever time frame you are in, it means each and every candle that forms, it took that candle complete its formation. So as you can see right now, we are in hourly time frame. So your market is moving downward, which is bearish, and it seems to be heading to this other block. So let's drop down to our 15-minute time frame. Maybe we'll find some kind of confluence to ride this market down. So as you can see, let me mark the swing points so everything will be clear. As you can see right now, assuming this is your lower high, lower low, lower high, lower low. No, this is actually not your lower high because it doesn't break any structure. You have to wait for it to break this structure for it to become a high. Then now this high actually break this previous high. Now this is your higher high. This is your higher low, higher high. And then we didn't have any structure break until here, until right here. Then this is your lower low, lower high, lower low. It continues on and on and on and on. So as you can see, these are your internal structures. These are your internal structure. They are actually irrelevant. You cannot trade them. Unless if you are going to drop to another lower time frame, maybe the 5-minute or 3-minute, which is actually risky. Just stick to your 15-minute time frame if you want to trade. So as you can see right now, this market breaks this structure right here. This market breaks this structure right here. Let's mark it as B. Let's clean this up. And then it also breaks this structure right here. Let's mark it as B. So now we expect this market to continue breaking this structure until it reaches this other block. Now, this is our first confluence. So from this price leg, we have two other blocks. I can see two other blocks that are visible. This is our first order block right here. This is our first order block. And also, we have our second order block right here. So if we can use our Fibonacci retracement level and check from the high to the low, as you can see, all of them are above the 50% of the Fibonacci retracement levels. This one lies at the 50% of the Fibonacci retracement, but this one is a low probability order block. The reason is it sits on liquidity and it doesn't take any liquidity. So we are going to consider it as a liquidity. As you can see, there's a liquidity right here. This is a liquidity. These are liquidities because they are equal highs. And market tends to take any liquidity before going to whatever direction it would like to go. So this other block is a low probability order block. And also, as you can see, there's a fair value gap. Yeah, there's a fair value gap. But it actually sits on liquidity, so it's a low probability order block. Now we're going to take it down and see if the market is going to reach this place. Now, let's spread the price. Yeah. Now the market hit this order block with a wick. So what you can do, if the market hits your order block, all you have to do is drop down to your lower time frame, maybe to 1 minute or to a 3-minute time frame. Let's do the 3-minute time frame. As you can see right now, the market hits our order block by wicks. So let's mark our swing points. As you can see from this moment, as you can see, the market, let's assume this is our higher low, higher high, higher low, higher high. This is considered as a higher high because it has a lot of multiple candles right here. So this is our lower high from the 3-minute time frame. So as you can see right now, the price swept this liquidity before before hitting this other block. So now this is where we would like to see a change of character happens. If a change of character happens right here, then we are going to place an order. So let's see what the market is going to do. As you can see right now, the market breaks structure with significant momentum. Breaks structure. So it changes character. Sorry. The market changes character right here. And we have our order block. Let's go to our 5-minute time frame. So let's use this as our order block because it has a fair value gap and all. As you can see, this is one of the benefits of using this lower time frame confirmations. This is the low that we are expecting it to be taken out. As you can see, we can now place our order right here. Our stop loss should be a little bit above the order block, and our take profit should be here, which is 1 to 6.5. But first, we should take our partial right here. Our partial take profit. Our partial take profit, we'll be taking it right here at 1 to 3.98 right here from this swing low. Now let's mark this off as our first take profit. Now, if you want, you will take your first take profit, which may be, you might take 50% of your trading position right here, and then your final take profit should be at the swing low. Or if you want, you will take it all the way down to this other block. But for this time, let's take our take profit right here. As you can see, we place our order. One of the advantages of using this is our trade probability right now is so high, and also our risk to reward has been improved. Let's say we decided to use this 15-minute order block as our entry. Our stop loss should be right here. Our take profit. If we could have used the 15-minute order block as our entry, our stop loss should have been right here. Profit should be right here. As you can see, all we have is only 3.7 risk to reward, and it's a low probability because we didn't confirm anything. But as you can see right now, with this confirmation entry, we have much bigger risk to reward, 1 to 6. Now let's play the price and see what's gonna happen. Price tags us in. Now let's continue playing the price. Now our first take profit is being hit. Now, if you want, you remove the 50% of your trading position right here and leave the remaining to run. And also your stop loss should now be at break even. Your stop loss should be at break even right here. Let's continue playing the price. And boom, final take profit hits. So this is how simple this trading strategy is. So if you enjoyed this video, please hit the like button and subscribe button. It won't cost you a dime.